All right, everybody, how we doing tonight?
Good. Thank you.
So I just started the recording to YouTube, and we'll give it another minute here, let other people jump in, and then we'll get going.
Got a few visitors here tonight. Welcome to the Foundry S&D software. We're here to help traders. Our main goal is to the benefit of traders without spending tons of money to do it.
Okay, it's 6 o'clock. Let's get rolling. So we opened up this meeting to basically anybody who wanted to attend, because we've been looking at different things around entries and exits and how they impact our trade plans, our profitability, how much we spend in commissions, all those types of things. And there's been a small group of us working on some of this, but we really just wanted to get more eyes on things and to see what other ideas folks had, so that we can all kind of work on refining our trade plans and making them more profitable, and maybe not spending so much money, giving so much money back and giving so much money away in commissions. So with that being said, let me go to my next slide here. I think, most of us are supply and demand traders, and we pretty good at finding supply and demand. But then when it comes to how we want to get into the trade and how long we want to stay on the trade and when we want to get out, that gets quite a bit more complicated. And, we were brainstorming and talking about there's so many different ways to get into a trade. And as we looked at that, you can look at, the location in your supply or demand band. Do you want to use a fib? Are you looking at a 88.6 to get in? Are you just always going to take the proximal of your band? And then, depending on your band creation method, your bands may be wider or smaller, so you may miss entry. And then some people like that confirmation trade to know that, price has come into the supply or demand band and it's going to, go back, turn and go out in the other direction before they jump in. And then let's be honest, some of the bands lately have been huge. And so, you're looking at how do I minimize my risk? So if you only want to risk $500 on a trade, that may change, where you get in, and you might miss getting in. The other thing that we've really been looking at that seems to be really important as we dig into things is the time of day you take the trade. Now, not for in my research, it's not so much the time of day that the band was created as it is the time of day you take the trade. I don't know. Has anybody else noticed that? And y'all feel free to talk. Open your mics up. No worries. This is meant to be interactive.
I've definitely seen that. There are sweet spots during the day where the zones just hold better. I heard somebody.
I think it might have been Aviator Steve. I think he's having a little mic problem there. And I know that some people use a lot of odds enhancers when price comes into a band to determine whether or not to get into the trade. Obviously, if you're doing that, you got to be sitting at your computer, making sure that all the stars align. I know on some platforms, I think you can have more flexibility to put requirements in on the trades. I know you have some flexibility in Thinkorswim. Does anybody know if that's an option on some of the other platforms like Tasty Trade or Trading View? Or I guess Ninja would be the other one, right?
Ninja, there's Webull, there's several of them out there right now. What are you guys actually using to trade right now? Can you give us that information? What platforms?
Yeah, even if you want to, you can just throw it in the chat.
That would be good.
I start on TradeStation and I place all my orders to TradingView.
Yeah, I chart on TradeStation, place orders on Thinkorswim. Okay, Marie, use TOS. Yeah. All right. So, yeah, so when you start looking at the odds enhancers, depending on how you're using them, the challenge is you got to be sitting in front of the screen, which may or may not be an option because you might have a day job or kids or grandkids, as the case may be, that keep you busy. And then, another thing is some people have really talked about, they don't want to see any basing before price enters a band. Some people like to see a sign of strength before they get in the trade. So they might, if they're looking at a demand band, they might want to see on a lower time frame a green candle print before they, enter the trade as a market order. And then there's also, looking for an indication of a trend change. So if you're doing a higher time frame, like a daily band, if you go down to a 5 minute and you see, a drop based rally, indicating you've got a trend change or two bases, in the opposite direction, whatever kind of strategy you use there, there's a lot of different ones of those. How do you look at that trend change? And again, we just kind of hit the lower time frame confirmation here. And then some people like to scale in, based on, they might get their first contract at the, at the proximal and might get the other one, the second contract deeper in, and so that they can reduce their risk. And some people really like looking at those quick pullbacks for entries as prices change in direction. And then, of course, if you're an options player, one of the key things you're looking at is the volatility. So as we've kind of like talked about, there's a lot of different strategies for entries. And, I know different people use different things. So if you have any feedback on something you're using that you think is really awesome, we'd like to, kind of get everybody working together as a team and look at, putting some numbers around some of these different entry methods so that we can say, okay, with confidence, hey, we've tested this. We see that this is a good thing. So I'll just open it up. Does anybody have any method that they particularly like right now? Okay, by the crickets, we can assume everybody's still looking, which is kind of the reason we're having this discussion in the first place. So, and then when we start, and to me, I'm a little easier at getting into trades, but I'm going to tell you, figuring out when to get out gets a lot more challenging. So, I think we've all looked at the whole idea of risk to reward and looked at, okay, let's do the free trade method, take one contract off at 1-to-1, and then have another contract that, rides either to 3-to-1, 5-to-1, the next opposing band. But, I'm going to be honest with you, I've done a lot of testing of this, and looking at certain assets and time frames. If you are looking at trying to do the free trade method, it does not work. You get chopped up. You lose a lot of money. You're actually better off just to run more contracts and take them to 1-to-1 and exit them all at the same time than to try to go to 3-to-1 or 5-to-1. And I'll show you a quick snapshot of a little bit of data. That is an example of some of the stuff I've collected trying to understand this. Because I don't know about you guys, but, when you're maybe 40, 50% on hitting something 1-to-1, but you're 10% hitting, only 10% of your trades make it to 3-to-1, that's, that can chop you up pretty fast. Yeah, emotions really play into it, Everardo. That's the reason I like to kind of like put some numbers around it, back test it, and try to figure out, what is going to give me the highest probability for success. The other key is, as I look at back testing and trying to put numbers around stuff, if I know that my trade plan, that it wouldn't be unusual based on my historical testing, that I could lose 5 trades in a row. Okay, no, what I'm saying is that it depends on the contract and the time frame that you're trading in. Like, I find an example is copper on a 21-minute chart. If I trade that in the evening hours from 18 to 20 Central Time, exchange time, and I trade one contract, or I do 2 contracts trying to ride the second contract to say 3-to-1, with the stop outs I get on the second contract, I actually make more money if I just did 2 contracts and took them off at 1-to-1. Does that make sense? I'm finding it depends on the time of day. It depends on the asset and the interval you're trading. There are some assets that you can trade very well, and kind of the morning regular trade hours, a typical 3-hour trade time, and they'll do well. But I still find, and I'm still back testing and digging into this, but I'm finding in a lot of cases, I'm better off just taking my first target off at 1-to-1, no matter how many contracts I'm trading. And that's me for my personal trade style and how, I mark the bands, but it's not what I expected to see. And it was pretty surprising. The other thing I have found as I looked at time of day and entering, is that actually I make more money trading in the evening hours than I do during the regular market trading hours. And again, that's just me, my style, but it's not what I expected to see. All right. And then looking at exits, sometimes we're looking at opposing bands. And I'm going to be honest with you, I have found that if there's cases where I have an opposing band and I don't take the trade because I don't have, 1-to-1 or 3-to-1, whatever my goal is to the opposing band. And I found opposing bands, depending on the time, like I said, depending on the time of day and what you're trading, they really don't create a problem. I would actually lose more money by not taking those trades. And then, in some cases, you can look at how price moves on an asset, and, you can just say, okay, I'm going to trade this asset on this time frame, this time of day, and I know I can consistently make $200 or whatever it is. So there's a lot of different ways to think about your exits. And then obviously there's always the stop. You don't like it when you get stopped out, but the opposing side of it is you could lose a lot of money. Of course, the other thing, we see with stops is, how many times you get wicked out, by just a handful of ticks, and looking at that so you can better set your stop. And again, I find that really is important to be looking at the different asset, and the time of day you're trading it really affects how much, wiggle room you need on a stop. Some people, use trail stops. I personally have not played a lot with a kind of an automated trail stop. I have used Michelle Amato's bases and swing highs and swing lows to trail, trail stop. And it works out pretty well. It's not perfect. But it's not, it hasn't been a bad way to do it. Let's put it that way. And then a lot of people will use indicators for exiting the trades as well. Full disclosure, I'm not one that really uses indicators to exit trades, but I know a lot of people do. I don't know if anybody wants to comment on that.
I've used basing candles where I have a basing candle or two basing candles above my long entry. I'll move it to the second one, the furthest one away from it. And as it moves up, I will continue to move the basing candle. So I've got effectively two between current price and my stop.
Yeah. So using the rule of two.
Yeah, rule of two.
Yep. Okay. Another interesting one to talk about is the time in the trade. I have found, particularly this really applies to the regular trading hours. So if you're looking at like somewhere around 8 Central to 11 Central, around that time range, I have found that the trades I get into personally, a lot of times, if I don't hit my 1-to-1 in the first 14, 15 minutes I'm in the trade, it typically will go against me. So I don't know if you guys have seen something similar to that.
Is that in futures?
Yeah, that's in futures. Yeah, to this point, most of my back testing has been in futures. So done some with some of the stocks and stuff, but mostly been doing futures lately, just because that's been a good place for me. And then some people will exit when they see a trend change, which Doug just talked about, the break-in, of two bases, or, it could be that you see, an opposing pattern created. And so that will, make you want to exit. Interestingly enough, I have seen that if, let's say you're trading on I like fib numbers. So let's say you're trading on a 21 or 34 minute chart, and you get into a trade and you go down to a 1 minute chart. Interestingly enough, what I've noticed is as price on that lower time frame creates supply and demand bands, that once, if you're getting in if you're in a long trade on a higher time frame and you see price make a supply band on the lower time frame and it breaks that lower time frame supply band, it's usually smooth sailing to your 1-to-1. And that's something that I've been really kind of paying close attention to. Just again, trying to figure out how do you what are those options? How would you trail? And then of course, some people, they're going to close at the end of the regular trading hour session, or, on a Friday, because they don't want to hold over the weekend. So that's in some people's trade plans. And, understanding, is that something, if you're not comfortable holding overnight, that may impact when you want to get in a trade, because you might not have enough time for that trade to actually, based on the ATR and how much price moves, you may not be able to get near your 1-to-1. So I've seen that, that can be a challenge as well. And then some people will hold something to the end of the contract. They're doing spreads. What they buy, they buy one contract and sell the other contract. I haven't played with that, but I know some of the big
one, you buy one and sell the other contract of the same asset or correlated assets, and one will typically lose money and the other gains money, and you have to look at it and to see where you got to get in at the right spot. I'll put it that way.
Right. And then some people will use the fibs to get out of their trades, or they'll, we talked a little bit about the base highs and lows to get out, forming an opposing band. Some people will dump out. And then if we're playing with options, we got to look at volatility. We got to look at time, the other Greeks, because, those are things that you want to track, because that may indicate, give you indications that, you want to, if you've made most of your premium, it may be a good time to dump out, as you start to look at the Greeks and what's going on there. So, so that's kind of, I've talked a lot about different styles of entries and exits. And like I said, the goal is really to try to get a group of people engaging, and let's take a couple ideas and do some testing on them, whether it's just manually marking charts, or we can, just collect some data, some screenshots or whatever, and just to start to see, what things might give us the best success. All right. And so let me show you a couple things here to kind of give you some ideas of things to think about. Here's a couple of my graphs showing the cumulative P&Ls exiting at 1-to-1. Okay, so this is the RTY in the evening hours, and copper in the evening hours. And you can see, if you look at the charts, you can see that, there's times when you're going to have, $500 or so of drawdown, trading 1-to-1 RTY in the evening. Let's see, probably about $500 as well on copper, trading 1-to-1 in the evening. I only had like 14 trades on the RTY when I collected it. I got 37 on copper. I like to have at least 30 data points to kind of feel good about the information. So, looking at that, if you collect some information on how you want to, in this exit strategy of 1-to-1, I collected the information, plotted it, and I was able to kind of get a feel for, how much drawdown and what the potential is, right? So, I think the time frame for this data was about 5 months. So, you're taking 37 trades in 5 months. So that's the other thing, as we kind of look at if we're going to narrow the time of day we're going to trade, or, the rules we put can reduce the number of trade opportunities. But if you're getting a good result, that may be totally fine. It just depends on, how much revenue you want to get.
Lisa, what was your biggest drawdown in that? One, it looks like over there on the RTY, it looks like it was probably about $700 right there.
It was 2,000 to 1,500 are the lines.
Oh, okay.
So yeah.
So about $300 there.
Yeah. Yeah. And then on the copper, you're looking like, looks like it's probably about 500.
Looks like you started below zero there on that first trade though.
Yeah, no, don't you hate when you start out that way? Same thing
Boy.
here. It's like,
Hey.
what the heck?
You
I
know-
think there's like some kind of like rule that the first trade you do is gonna like, you got to give some. I don't know.
It almost always works out that way for me. So
Yeah. So, all right. So then, I'll show you. This is what copper looks like if you do 2-to-1. Okay. So you can see, we had 34 trades that made it to 2-to-1 out of the 37. So that's a good number. And so, looking at this, but here, you've got about $1,000 of drawdown. So, those are the kind of the things that I saw as you start looking at holding the trades longer. You will see those bigger drawdowns. And when you have a smaller account, that can really hurt. Let's see here. All right. And then I'll show you this one. Look at this. Trading Japanese yen in the morning hours is a hot mess.
man, that's nasty.
Isn't that awful? It is ugly.
Talk about a monster mouth.
Well, yeah. And, you could be trading it and saying, okay, well, I'm losing some. I'm winning some, losing some. But, in all reality, it didn't matter. 1-to-1 was bad. 2-to-1 was bad. It was just a hot mess. I think that's one of the things I've learned is your account can, whether it's going up or down, actually charting the individual assets and understanding how that asset is performing, because you can find out that there's one asset that's driving all your profitability and you can just kill the other ones.
Right. So when you look at profitability, do you look at your profit factor at all? Do you take that into consideration?
Yeah, on some level. but I'm more focused on looking at the cumulative P&L.
Okay.
That's my kind of go-to metric. I don't know what everybody else looks at. We are actually running out of time here. It's 6:28.
Yep.
So I just did this as a quick 30-minute meeting to show you guys like kind of some of the things we were thinking about, to see if you guys would be interested in, in attending a meeting on a regular basis, or giving. I know some people can't attend because of other obligations, but they could, watch the videos that we're producing and provide us, feedback and thoughts on things. But I was thinking this could be, we're already kind of going down this path, and we were thinking if we could get a few more folks involved, a few more eyes on it, give us different perspectives, we thought that would maybe help accelerate and get us to some good conclusions faster.
Good presentation. Thank you, Lisa.
You're very welcome. I hope everybody has an awesome rest of your evening. And for those of you who this is the first time you've made it here, this is an open forum. You can come and hang out here. We have a calendar. You can attend sessions. And we can also, see if there's one meeting, if this is not a good meeting time, we could possibly pick a different time that the folks that want to participate could, attend more easily. So, thank you, May. Yeah. So I'm kind of excited about what I've learned so far, and I'm just excited to kind of take it to the next level. So I want to be respectful of everybody's time. So I'm going to stop this now. Anybody have any additional questions before we close out?
I'll just mention right now, everyone here, feel free to come into the room and see what's going on. There's generally somebody here, Tim or myself or Aviator Steve. There's a lot of, and we have sessions that are being scheduled. I'm doing a weekly session on Thursdays at 3 on back testing. And like I said, we've got several other sessions. We have a calendar for the Foundry, which you have access to. So come in and check us out. And if you have any questions on anything, feel free to ask.
Yeah, and we got Rich doing his crypto session.
Oh yeah, that's tonight, isn't it?
Yeah, that's starting right now. So